outgrown their existing site to have another building. We did a flooring company that had a pretty good showroom for his product, but he wanted to have a wholesale discount showroom to separate them. So the first one was pretty successful. We was able to do another one for this gentleman. Transwest Security. You've probably seen the Transwest Security cars around town. When it came time for them to buy a new building, remember the Rosedale Tile building I talked to? They happened to buy that particular building, so it worked out really well. And we do office condos. If it's commercial, if it's eligible commercial real estate and it's an eligible business, then we'll look at those projects. Plumbing contractor, we did Valadon Plumbing Contractor. Again, a customer that had a smaller location and needed to grow into a facility. And if you're leasing a piece of property out there, if you have the ability to transfer those lease payments into your monthly mortgage payments, somewhat of a no-brainer. Yeah, it's not such a drastic change in your cash flow. Hall of Fame Dental, we do dentist offices, and this is in a shopping center project in Kern County. So again, if it's real estate tied, we can consider it. And manufacturing, we have a paper manufacturer in Shafter that this is our third project with. It's one of our larger projects in Kern County. This is also a project that we've done in Kern County, oil field service company. Very nice operation. They had been leasing multiple spaces and needed a piece of property, and this property worked out perfectly for those guys. We had some success in a market in Kern County where this is somewhat of a PUD complex that we have financed 5 projects into that particular area. Infinity Communication is another great small business that as soon as they moved into the building, their business continued to take off. And doctor's office, as you can see, we've done those. This is in that same complex. That's that Iron Gate. Deal structure, typically if they have existing land that has been held for over 2 years, we can give you the appreciated value of that particular land. You can also have lease options with a percentage of your lease payments going towards the equity injection. And we will consider owner carryback equity from time to time, but we always like to see some skin into the game. Deal structure, multiple borrowers. We have many projects where there is a piece of property that is important to customers. They've entered into some type of partnership where they can't take the whole property because they can't, debt service the whole thing, but they can do it on a partnership. So we can do that. We have, as I mentioned before, customers that have done several projects, and we have what we call multiple projects within that limit. Under our program, we rarely take additional collateral. Ours is typically a program where the business has been around for a while, and our focus is primarily on the real estate or equipment that they're buying. And we will also do projects on leased land. In certain areas, there are not land available, whether it's near an airport or the desirable land is only on a lease basis. We will do that. We'll take leasehold improvements. Our involvement, we will meet with everybody. Client, broker, bank account, lawyer, mother, whoever's involved in the deal. First, we always like to determine eligibility up front, and whether it's a legal entity, if it's an eligible project. We try to gather most of the financial information, the cost information, and we coordinate and partner with the bank. So we're going down a dual track. Whether it's, we typically like to start with your bank first, but we have several banks that we've done a lot of projects with that we will bring into the project as another option for a particular customer. SBA takes typically 5 to 10 days approval. That's on a completed basis. SBA loans are once a package is completed and underwritten, are fairly easy to get and apply for. And with that, Kelly, do we have time for questions, or are we going to give it to Matt?
Well, I see a question right here, and it's usually the typical question that we get with something like this is, what's your current interest rates, Keith?
I think I mentioned earlier the current interest rate is 4.9%. Again, that's on our 40%. The bank will set their rate. But I will tell you, the rate environment today is very good.
Fantastic, and a super program out there for fixed asset acquisition. So if you have questions, Keith's going to stick around. We're going to bring on our next presenter, who happens to be Matt Damian, and Matt is the SBA person, the SBA manager, vice president at Mission Bank. He's done a lot of deals, as you've heard with Keith. He's been very successful in doing a lot of the 504 program loans, but he also does another element called the SBA 7A loan, which I'm sure he will define for us. So thank you, Matt, for being here. Take it away.
Kelly, thanks a lot for having me. I just want to say Keith didn't promote himself. He's a very humble guy, so he didn't talk a lot about himself, but I would just say that if you get an opportunity to work with Keith on a 504 project, he has the ability to get into a meeting with all the players that are involved with your project and kind of guide you and everybody in a very clear and concise way down the path that is the best option for you as a borrower. So just great working relationship with Keith, and he's a great asset in the community. So like Kelly said, I'm going to be presenting about the SBA 7A loan program. It's one of the most popular and most flexible loan programs available to you right now. And so I'm going to talk a little bit about all the different options that the SBA 7A loan program are going to be able to offer to you. So let me see here. How do we move forward on these slides? There we go. Outstanding. So here's a real quick overview. We're going to talk about the SBA as an agency. We're going to talk about the 7A loan program, kind of how it works, eligibility, just get into some specifics, what you can and can't do with a 7A loan. I'm going to talk about I'm going to talk about all the advantages and disadvantages of the program, because obviously there's some pros and cons with working with this SBA program. And then also I'm going to talk a little bit about preparing your loan application, some of the things that banks are going to want to see, and so you can be prepared for that. The SBA. So the SBA is a federal agency that was founded in the 50s, 1953, it says here, according to my slide. So specifically, their function was to aid, counsel, assist, and protect, insofar as possible, the interest of small business concerns. In essence, they're encouraging financial institutions to make loans to small businesses in the way of providing guarantees to that bank. So let's talk about a couple of elements of that phrase there, as far as small business goes. So a small business is typically defined as a business having less than 500 employees. When I think of the term small business and I relate it to 500 employees, a 500 employee company is not anywhere near small in my experience. So just the small business, however, makes up 99.7% of firms with payroll in the United States, and small business pays 49% of private sector payroll in the U.S. So it makes up a huge portion of private businesses in this country. So then if we talk a little bit about how this 7A loan program works and what it's used for. I'm going to talk a little bit about how the program works. So with Keith's program, as you remember, there is participation from a bank. A bank loans a portion of the money. The SBA will loan a portion of the money in the form of a debenture through mid-state development. And then you as a borrower would put up an equity piece. So you'd put up your 10%. And so you'd have a 50% loan from the bank, a 40% loan from mid-state, and a 10% loan, or 10% of the project would be your equity. 7A loan, actually, this is a loan that's going to be from the bank in its entirety. So underwrite a bank loan. The bank would request a guarantee from the SBA based on all the parameters that the SBA requires the bank to fill. There would be a guarantee fee paid, and then the SBA would guarantee up to 85% of the loan amount against any loss. So what that means is let's take a $100,000 business loan, and the typical guarantee amount is 75%. So what in essence is happening is the bank is loaning you $100,000, and the SBA is saying, hey, if you incur a loss, Mr. Bank, then we will reimburse you for that loss up to 75% of the loss amount. So it's a strong incentive for the banks to extend loans in the instance of small businesses. Let's say it's a startup or it's a little bit more of a quote unquote risky loan for the bank. It's enticing them to be able to do that. So let's talk a little bit about eligibility. So in order to be eligible for a 7A loan and for an SBA loan in general, you've got to operate for profit. You've got to be small as defined by the SBA. Keith went over some of those parameters. In essence, I've very rarely have I encountered a loan in the last 10 years. I think I've seen 2 projects that weren't eligible because they weren't quote unquote small as defined by the SBA. So there's a lot of flexibility there. You've got to be engaged in business in the United States, have reasonably invested equity. The SBA has their own requirements in regards to equity, but each bank also has specific requirements. So you need to be clear when you're we'll talk about that a little bit and more of the presentation goes on, but you need to be clear with when you're talking to a bank. They may say, oh, well, we require 50% down, let's say, for this type of a project. And you need to ask them, well, is that an SBA requirement or is that a bank requirement? Because there's a difference. So another part of the eligibility, how that works, you've got to use your personal assets before seeking financial assistance. In other words, if you've got $100,000 in cash sitting in the bank and you're asking for a loan for $50,000, the SBA won't be a program for you. You've got to demonstrate a need for the loan proceeds. So what are you using it for? You've got to explain that. Use the loan funds for a sound business purpose, and that's we'll talk about some of those different categories of what makes a sound, but what is defined as a sound business purpose by the SBA. And you can't be delinquent on any debt obligations to the U.S. government. Keith mentioned that as well. So student loan defaults or some of those government loan taxes or government loans that would make you ineligible. So then let's talk a little bit about what you can use the money for. Long-term working capital. So in essence, instead of a line of credit, this is a permanent term loan that would be used as working capital for covering business needs. Short-term working capital needs. So there are some line of credit facilities or line of credit loan programs that the SBA offers. Revolving funds based on the value of existing inventory receivables. That would be that line of credit option. We also can purchase equipment, machinery, furniture, fixtures, supplies, or materials. You can purchase real estate, including land and buildings, as a part of this program. You can construct a new building or renovate an existing building. You can use the 7A program to finance tenant improvements specifically. So if you're leasing a facility and you need to do a tenant improvement, a loan or remodel the facility that you're leasing, you can borrow funds from the SBA to handle that project for you. You can use the loan funds to establish a new business or assist in the acquisition of an existing business. So you can buy, let's say you're work for a manufacturing business and you've worked for them for 10 years and the owner wants to retire and wants to sell you the business. That's a program. The SBA 7A program can help you do that. They can also assist with partnership buyouts. So if you have a partner that you're looking to buy out of your company, you're allowed to do that as well. You can refinance existing business debt. You've got to. This is one of those categories where it's very specific, and so there's some very detail-oriented analysis that the bank does to make sure that those funds are eligible to be refinanced. And it basically gets down to you got to prove that you use them for business purposes. So, but it is possible to refinance existing business debt. So some of the things that 7A loans can't be used for, you can't refinance existing debt where the lender is in a position to sustain a loss and the SBA would take over that loss through refinancing. In essence, the bank can't use the SBA loan program to assist them with making a loan that they perceive to be in trouble, less of a risk for them. That's really more of a bank thing, but I like to throw all the different options or all the different variables on the table so you can kind of see what the program's all about. One of the other things you can do is a partial change of ownership within a business. So a lot of times I'll have the medical practice is probably the best example of this. If you have a group of 4 doctors and a 5th doctor wants to buy into the practice, you couldn't use an SBA 7A loan for that one individual to buy a portion of the business. It would have to effectively change the entire ownership. There would have to be a complete ownership change in order for that program to be eligible. You also can't use the 7A loan program to reimburse funds owed to any owner. For example, if you've got a partner and they've loaned the company money, you couldn't borrow an SBA 7A loan to pay that partner back. You also can't use a 7A loan to repay any delinquent state or federal withholding taxes or any funds that are going to be held in an escrow or a trust. So let's talk about some of the loan terms, loan repayment terms. So like I said, this is one of the most flexible loan programs. Like I said, you can buy real estate, you can buy equipment, you can buy inventory. And so all of those different asset categories or asset classes have a different repayment term. So for real estate, we can finance that up to 25 years. Fully amortized loans, by the way, we can do 10 years for equipment, up to 7 years for working capital. And one of the most attractive things about the SBA 7A loan program is that there are no balloon payments or call provisions on the bank's end. So while on a conventional loan, you may say, I'm going to amortize this loan over 25 years, but after 10 years, there's a balloon payment due. Well, the 7A loan, it's fully amortized. Every loan is fully amortized. There are no balloon payments. Collateral. So the SBA expects each loan to be fully secured, but one of the nice things is that the SBA will not decline a loan based on a lack of collateral if that's the only unfavorable factor, assuming that all available collateral is being used to secure the loan. This becomes probably one of the trickiest things to explain and conceptualize when you're dealing with SBA 7A loan program is, in essence, if you have collateral to secure the loan, they're going to take it. But if you don't have it, they won't necessarily decline the loan if that's the only negative part of the application package. Where this becomes the trickiest is, I guess, would be when you're buying real estate. Because, for example, in the 504 loan program, they don't take any additional collateral. You put your down payment down, you buy the building, there's a first and a second trust deed, and then you're done. With the 7A loan program, you can go up to 90% loan to value, but there's some additional collateral in different situations that has to be pledged as a part of that purchase. So when you've got to really have a SBA loan officer that knows what they're doing, knows the program, and can explain that to you so that at the end of the transaction, when you go to sign loan documents and there's a trust deed for another piece of property, that you're not surprised by that and that you understand that that's gonna happen. Loan amounts and fees. So the maximum loan amount is $5 million for the 7A, and again, it can be multiple loans. You can borrow, multiple SBA loans, but the maximum is $5 million because of the guarantee based on that amount. So fees. Here's a current fee schedule. It's displayed. This changes. Sometimes they'll have. I don't want to say promotions, but different economic stimulus programs. So they'll have a waiver of a loan fee from the SBA for loans under $150,000. But this is the current. This is a current fee schedule. So under $150,000, there is no SBA guarantee fee, and then you can see it kind of goes up from there. Over $150,000 is 25 basis points or 0.25%. Up to $700,000, it's 3% of the guaranteed amount. So you can see that. The fee starts getting a little larger as you get in a larger loan amount. And there's that's part of the pros and cons of this program, and we'll talk about a little bit later in the presentation or towards the end of the presentation. We talked about this a little bit, but I wanted to show you a slide that kind of graphically represents what you can do with a 7A loan. So this kind of shows you if it's a real estate loan or if it's a non-real estate loan. This will give you a real clear idea. So with the real estate program, buy commercial real estate, build a building, refinance commercial real estate. Again, pointing out some of the differences between the 7A and the 504 loan program. With the 504 loan, currently, you can't use that loan to refinance existing debt on commercial real estate. And there's some very, very specific circumstances where you can, but for the most part, as a rule of thumb, you can't. Whereas the 7A loan program, you can use that to refinance commercial real estate. So that's If you're looking to refinance a building and you need a higher loan to value than a conventional loan, the 7A loan might be a perfect fit for you. Again, up to 90% loan to value, up to 25-year amortization, fixed and variable rate options are available, and the collateral is the real estate being financed, plus additional collateral if necessary, like we talked about. For the SBA 7A non-real estate program, you can do tenant improvements, so building out a lease location, equipment purchase, business acquisition, partner buyout, inventory purchase, debt refinance, working capital, and there's any combination of those. So if you needed to do tenant improvements, buy some inventory, and buy out a partner, you could do that all in one loan. That's part of the beauty of the program, is it's so flexible. Again, up to $5 million. The loan to value I put up varies from 70 to 100% based on what you're using it for. There's situations where we do 100% financing with the 7A program, mainly partner buyout. Let's say you own 50% of the company, you need a loan to buy out the other 50% partner. If you're doing it, that's basically 50% loan to value. So it's possible. That's up to 10-year amortization. There are fixed and variable rate options available. And again, same collateral. It's assets being financed plus additional collateral if necessary, or if mandatory by what the SBA guidelines determine. So what are some advantages and disadvantages of the program? This is just a highlight of things that we've already talked about. Longer loan term, longer fixed rate period, higher loan to value. There's a fully amortized rather than a balloon payment option. The use of proceeds is very flexible, and the underwriting standards are more flexible. And what I say by that is when the bank looks at your loan application, they look at, a global financial picture. Personally, how much money do you make? How much money does your business make? What's your capacity to repay the loan? When you're looking at that picture from a conventional basis, typically banks will be a little more rigid on their requirements, whereas on the 7A loan program, because of the assistance from the SBA, they're willing to go a little bit more. They're willing to be a little more flexible and a little bit more aggressive in some instances. So that's good. What are the disadvantages of the program? There's some higher fees involved. Typically, that's mitigated by the high loan to value and the flexibility of the program. When you start looking at it as a balancing out what you're getting for the fee that you're paying, a lot of times if fee is financed, it really is still a viable option, but the fees are high in some instances. And then again, additional collateral in some instances, still a trade-off. You're still getting some great financing options for the fee that you're paying. So we did talk about a couple of the credit factors, but basically this is what, when you're preparing your loan application, this is what the bank is going to be looking at. Equity investment, how much your money you're putting down, collateral, what's securing the loan, working capital, how much money you're going to have left when you put the money down, cash flow, how much money you're making, and then management experience in the industry that you're participating in. Here's kind of a checklist of some things to look for, to have prepared when you do meet with your bank. A resume, so what's your management experience, a business plan and projection if that applies to your specific loan. You want to have your income taxes ready for your business and personal. You're going to want to have a personal financial statement. You're going to want to have a financial statement for your business. You're going to want to have bank statements, and you're going to want to know what's securing the loan, so what collateral is available. And then these are just some of the questions that your lender may ask you. Things like, how will these proceeds be used? Who are your customers? Who will be your customers? Do you have any business debts? And then maybe ask specific questions about how you came up with your projections. Being able to defend those projections and say, well, these are my sales numbers, and I think I'm going to hit these sales numbers because, these are the customers that I've already made contact with. These are the people I think I'm going to talk to, or maybe these are traffic counts, and according to this website or according to these statistics, I'll capture this much of the traffic. Really be able to tie all those numbers back to some sort of fact. You're really going to impress your banker, and you're going to have a real easy time talking through the project with them. That's really all I have for you today. I'm open for questions, and I'll hand it back over to Kelly at this time.
Thanks, Matt. Great information. Great loan program through SBA. We do have a couple of questions that are showing up here. The first one, I believe, revolves around eligibility. And you'd mentioned that student loans, if you defaulted on a student loan, that might affect your eligibility. What about a short sale on an investment property?
That's a good question. And for that specific situation, it's really on a case-by-case basis, and it really depends on the bank that you're working with. And it also depends on the situation of, as far as the short sale goes, what caused that, and really getting into a story about or painting a picture on that particular short sale. Why did it happen? What other things were going on in your financial picture in your life at that time? Or was it just, well, we didn't want to pay for it anymore, so we short sold it. So those are questions that you're probably going to be asked by your bank. But the presence of a short sale by itself doesn't necessarily disqualify you from getting a loan.
Great. And here's another question. It is more of a scenario of a loan situation. And it's generally an individual who is looking to purchase an existing business, a franchise. And the franchise has good cash flow. The applicant is looking to pay about $500,000, and the owner is willing to take a second position in that property. Is that something this SBA 707A could be used for?
Yeah, there's a lot of moving parts there. It sounds, you say property. So if there's real estate involved, there's a seller willing to take a second trust deed. So they're willing to carry back a portion of it, and the bank would be in first position. All of those variables can be put together in order to execute a business acquisition, whether it has property or not. There's seller carry. I've seen seller carrybacks where the seller took a second position behind the bank on the business itself, didn't have real estate. There's some conditions that the note that the seller carries back has to fulfill. There's some eligibility concerns, or not concerns, but there's some eligibility issues revolving around the franchise itself. Is the franchise eligible? That can be determined pretty quickly. Even if it's not eligible, there's remedies that can be taken to get the franchise to comply with the eligibility rules of the SBA. And subordinate position debt from the seller standpoint, absolutely. So I would encourage you to contact me if you want to ask me more questions about that. You certainly can contact me. And I don't know if our contact information is part of this deal or not. But
Well, there is also kind of a follow-up question to that also, and that is the franchise, is there any valuation in the franchise that is eligible for collateral? Because generally when I think of collateral, I think of it being a fixed asset, be it land or building or equipment or something like that. Is a franchise fee in a franchise, is that something that can be used for collateral?
typically when you're buying a business, let's say there's no real estate and you're buying a franchise that has maybe some assets, some equipment. Yeah, certainly equipment and tenant improvements and such are considered collateral. But you really get into that where I talked about the tricky part of analyzing a transaction is how much collateral. If you have a $500,000 franchise and there's $100,000 of equipment, and the bank and the SBA say, okay, well, $100,000 of equipment, we're going to give it a collateral value of $50,000, let's just say. So now you've got 50 out of 500 secured, and you've got a gap of 450. So the bank and the SBA would look for additional collateral to make up that 450. If you don't have any additional collateral, again, if that's the only negative factor, but cash flow is strong, your credit's great, you have great management experience, and the business outlook is fantastic for this particular industry, then you may very well still be able to get financed. So the answer is yes, we do consider non-real estate assets as collateral, like equipment, like inventory, like tenant improvements, but the margin that they give credit for that collateral is a lot lower than like what would be on real estate.
I see another question has come in. What is the smallest loan amount that generally Mission Bank will look at?
You know, it's on a case by case basis. I won't really give out, hey, this is too small, because as soon as I do that, then a loan for $10 less than what I said was the smallest loan, and it's a great project, and I shoot myself in the foot. So it's on a case by case basis, honestly.
Okay, I think that's all the questions we have. We do not have a slide for Matt's contact information, so I'm going to hand it back to Matt and let him give his contact information out, and then I'll wrap up.
You can contact me. I'm going to give you my office line. You can call me and ask any questions you have. Office line is 661-859-2521. 661-859-2521.
And if you had questions about the 504 program for Keith Bryce, you can contact him at Mid-State Development Corporation. Well, thank you for attending. Sorry a little for the technical issues, a little beginning of the webinar. We'll be back next month, better and stronger than ever. Have a great business day, and we'll see you. Goodbye now.